AI and accounting. Where do they fit together? How are firms changing today? And what does the future hold for accountants? The answers aren't always so clear because the world of AI accounting is constantly changing. Hi, it's Matt from Financial Sense, and in each episode of this show, we'll be exploring how accountants and bookkeepers are innovating in their use of artificial intelligence, how it's impacting them, and both the ups and downs we're seeing in the industry. So come along for the ride in the latest episode of AI Accounting, brought to you by Financial Sense. We start off every episode by focusing on a practical application of AI in an accounting firm so you can decide if it's right for you. Today, let's talk about transaction categorization. Now, at Financial Sense, this is a regular part of how firms use our software, and it provides huge benefits in month-end close. But what is this process actually like? If you've ever spent an afternoon staring at a blank export, trying to figure out whether a $47 charge from SQ Riverside LLC is a meal, an office supply, or a contractor payment, you probably already understand the problem AI transaction categorization is trying to solve. It's a recurring to-do in every accounting firm, for every client, and almost every single month. For most firms, it's still largely done by hand. This is where AI transaction categorization comes in. Payments in, payments out, every transaction needs to be assigned a category. Rent, payroll, software subscriptions, cost of goods sold. The list can be nearly endless depending on the type of company. Getting those categories right matters because everything from profit and loss reports to tax returns to cash flow statements are all built on top of how individual transactions are coded. When it's done wrong, you get financial statements that don't really reflect reality, and when it's done manually, at scale, it's slow, expensive, and prone to human error, especially when the same client sends over 500 transactions a month with cryptic merchant names. That's the problem, and AI can be the solution. So, here's the basic process under the hood of AI transaction categorization. The AI itself is trained on huge volumes of transaction data, millions of real transactions that have already been categorized by accountants. From that training, it learns patterns. Transactions from Delta Airlines usually go to travel. Transactions from ADP usually go to payroll. Transactions ending in .com from Adobe usually go to software subscriptions. When a new transaction comes in, the AI doesn't just look at the merchant name, it looks at multiple signals at once. Description, amount, transaction type, day of the week, client industry, even how similar transactions from that same vendor were categorized in the past. It then makes a prediction. Here's the account this transaction most likely belongs to, and here's how confident I am about that. High confidence? It categorizes automatically. Low confidence? Good software will flag it for human review. That's the core loop. Train on historical data, read incoming transactions, predict the category, flag the uncertain ones. Now, here's what separates an okay AI categorization tool from a good one. The best systems don't just rely on general training data. They learn from your firm's specific patterns over time. If you consistently recode a particular vendor from meals to client entertainment, the system should pick up on that and start categorizing it that way automatically going forward. If it doesn't, reconsider that AI. This is called reinforcement, learning from corrections. Every time an accountant overrides a suggestion, the AI model gets a little smarter about that client's specific chart of accounts, industry norms, and preferences. After a few months of working with a client, a well-designed system should be getting the vast majority of transactions right on the first pass, requiring human review only on generally ambiguous items. In practice, here's how this changes the workflow. Okay, ready? The old process. A client sends over their bank statement and their accountant opens QuickBooks or their ledger software of choice and manually codes each transaction one by one. For a client with 300 transactions a month, that might take 2 or 3 hours. The new process. Bank feeds connect directly to the accounting software. Transactions flow in automatically, and the AI categorizes like 85 to 90% of them instantly. Afterward, the accountant opens the file and spends maybe 20 to 30 minutes reviewing the flagged items and spot checking the auto-categorized ones. Same output at a fraction of the time. That time saved compounds really quickly. You got 20 clients with 200 to 400 transactions a month. AI categorization can free up dozens of staff hours every month. And those hours can go to advisory work, client communication, simply just handling more clients without adding headcount to your firm. Of course, you can probably guess that AI categorization isn't perfect. And we should be transparent about where that falls short. AI usually struggles with new vendors that the system hasn't seen before. It can misread vague or inconsistent merchant descriptions, doesn't understand business context the way an accountant does. Think of it as a super fast but limited assistant. That's why human review isn't optional. It's the quality control layer that makes the whole system reliable. AI handles the volume, the accountant handles the judgment. The firms getting the most value out of this are using AI to remove the repetitive parts of the job, not to remove accountants from the process altogether. That way, their people can spend more time on work that actually requires human expertise, which sounds nice. And while AI transaction categorization might not be super flashy and exciting, it does address one of the highest volume, most time-consuming tasks that firms deal with every month. And in any firm where time is a major constraint, that's a pretty big deal. Next up, it's time for some of the biggest news in the world of AI accounting. According to Reuters and Yahoo Finance, there may be $1 billion heading toward the accounting industry right now. But it's not coming from a bank or private equity. Instead, it's coming from the Silicon Valley venture capital firm that made its name betting on Stripe, OpenAI, and Databricks. It's Thrive Capital, and specifically one of their major companies, Crete Professionals Alliance, which focuses on bringing AI to services industries that have traditionally operated without much technology. The strategy is called a roll-up. Instead of building software and selling it to accounting firms, they're buying the accounting firms outright and are having them use their tech. Crete plans to deploy more than $500 million to acquire US-based accounting firms over the next 2 years. And once owned, Crete would equip them with OpenAI-powered tools to boost efficiency. This isn't a small experiment. Since it was founded in 2023, Crete has already grown to over $300 million in annual revenue and already have more than 20 accounting businesses that have more than 900 employees. Okay, so if you're in accounting and watching this, what does this mean for you? Well, Thrive's in-house tech team has been working directly with OpenAI to build customized tools specifically for accounting, things like data mapping and memo writing that are built to be used by accountants. According to some users, these tools have saved them firms hundreds of hours a month. The users of the software are also employees of the company that owns the firms using the software, so take that as you will. Still, it's what every firm is after these days, being able to add clients without adding headcount. And as for Thrive, representatives have said they believe owning businesses is the key to generating more value. The belief is that Thrive's expertise in AI, combined with a long-term holding structure, will help them build services businesses that are more efficient and scalable than traditional firms. And Thrive isn't the only one moving in this direction. General Catalyst, another prominent venture firm, is following a very similar playbook. When multiple top-tier venture firms start making the same bet, it's worth paying attention. The roll-up structure Crete uses lets them acquire majority stakes in local firms while keeping the original owners in a minority equity position, which means the accountants who built those businesses do get to stay involved. The accounting industry has faced a lot of challenges in recent years, including the lingering accountant shortage. And technology has historically played a major role in boosting productivity, similar to how tools like QuickBooks supercharged workflows a generation ago. What's happening now is a similar shift, but it's faster and with an eye on the entire structure of firms. In the big picture, initiatives like this will ultimately accelerate AI adoption across the industry, in some ways by force, which means that in order to compete, the rest of the industry must push itself to keep up so it doesn't get left behind. But there's still a really big unknown here. Analysts say that it will take time to see whether these AI-powered roll-ups can actually deliver the higher return that venture capitalists expect. And the return needs to be well above what traditional private equity has gotten from accounting firms. And to be fair, Crete's co-founder Jake Sloan has said the goal isn't to replace accountants with AI, it's to use technology to improve service quality, with humans handling the relationship and trust sides of the work. In any case, $1 billion moving into accounting coming from Silicon Valley is a huge sign that technology and AI are rapidly changing the industry, and firms should pay attention to what happens as a result. In the end, any investment from a venture firm like this is just what the name implies. A venture. Put money in, see if the investment is worth the amount of profit that comes out. Only time and the firms who take part and the clients that work with them will tell. For this episode's weird AI use case, let's talk about how AI may be able to help wildlife conservation. The World Wildlife Fund recently published an article on several different ways in which it and its partners are using AI to support their preservation and protection efforts around the world. One major leap forward that's attributed to AI is that programs like Forest Foresight are being combined with satellite imagery to detect early warning signs of forest degradation, deforestation, and wildfires. This is helping organizations quickly analyze patterns in human activity and forest health so they can jump on these issues as soon as possible. Personally, I find that pattern analysis and automated warning signals are some of the most fascinating applications of AI. These can really be applied to anything: customer interests, weather patterns, and here, the health of natural environments. On the more natural side of this application, WWF and Google have created the AI platform Wildlife Insights, which pulls camera trap data from organizations and citizens around the world to identify changes in animal population. Camera traps, if you don't know, are cameras that are triggered by movement in natural environments so that animals can roam freely without humans for better observation. On the human side, wildlife detection systems are being implemented at airports, docks, and more places with lots of travel to stop illegal wildlife trafficking. These systems flag illegal products and are being trained extensively on what to look for. And this makes it easier for inspectors to catch smugglers and save animals. I love saving animals. I think it's really cool. And in an era where advancements in technology and the health of our ecosystem are in constant conversation with one another, I love to see them coming together. And finally, we spend some time in every episode of AI Accounting talking about an important rule of AI that every accountant should understand before implementing it in their firm. So while you're experimenting with accounting AI programs, let's make sure you really have the fundamentals and foundational education in place. Today, we're going to talk about machine learning. Now, this is a term you may have already heard before and before the rise of AI, but its principles are still being used today. And it's probably because you've heard people say AI is learning. But what does that actually mean? It's not like a robot sitting in a classroom reading textbooks. The way AI learns is fundamentally different from how humans learn. And once you understand it, a lot of things about how AI are operating start to make way more sense. And if you're going to use AI, you should know how it works. Machine learning is a method of building software where instead of writing rules, you feed the system examples, and it figures out the rules on its own. The old way goes something like this. A programmer writing a traditional software would say, quote, if the email contains the word free money, mark it as spam. Good rule. Every rule written by hand, every exception handled manually. The programmer is in full control. Machine learning flips that. Instead of writing the rules, you show the system thousands of emails, some spam, some not, and you tell it what it is that it should look for. And the system looks for patterns, what words, what senders, what formatting shows up in spam, builds its own internal rulebook. You never have to write free money equals spam. It figures it out on its own. That's machine learning. Pattern recognition at scale, learned from examples. Here's how to keep this straight. Traditional software follows instructions. Machine learning software learns from examples. And if machine learning was a cake, a delicious chocolate cake. I don't like too much frosting on mine, a little too sweet for my taste. I like to focus on the cake, like maybe a couple layers with like cream cheese frosting in between, right? Oh, sorry. If machine learning was a cake, these are the basic ingredients. First ingredient, data. Lots of it. Machine learning models are only as good as what they've been trained on. If you want a model that recognizes cat photos, you need to have thousands of labeled cat photos. If you want one that predicts customer churn, you need years of customer behavioral data. Data is the raw material, the flour in the cake. Second ingredient, a model. Think of it as the structure. blank framework the system uses to find patterns. There are different types for different jobs. Some are good at images, some are good at text, some are good at sequential decisions like chess or routing. And the third ingredient is training. This is where the learning actually happens. You feed the model data, it makes a prediction, you tell it if the prediction was right or wrong, and the model adjusts. Do that millions of times and the model gets really accurate. This is called the training loop. What comes out the other end is a model that can make predictions on new data it's never seen before. Show it an email it's never read, it'll tell you if it's spam. Show it an X-ray it's never seen, it'll flag potential anomalies in the body. But machine learning isn't new, and really neither is AI. The concepts go back decades. It's just that now we have access to cheap computing power, massive amounts of data, and better algorithms. Training a model used to take months on specialized hardware that cost millions. Now you can train useful models in hours on cloud servers you rent by the minute. It's a much lower barrier to entry. That's why AI is everywhere right now. Not because the idea is new, but because the cost to execute it has dropped dramatically. But before you go running out to start training an AI model, don't skip this next part or you're going to wind up in trouble. Machine learning is extremely good at pattern matching. It excels when the future looks like the past, when there's enough data to learn from, and when the task has a clear right or wrong answer, or at least a measurable one. It struggles with things that are outside its training data. Ask a model trained on financial documents to summarize a recipe, and it might do okay, but it wasn't built for that. More importantly, it has no understanding of what it's actually doing. It's matching patterns, not thinking. It doesn't know why something is true, just knows that pattern A usually leads to outcome B. That's why AI makes confident mistakes. Like me. It's not lying to you, it's pattern matching toward a plausible answer, even when that answer is wrong. So don't take every answer your AI gives you as the gospel. Instead, consider tools that bring a human into the loop when necessary to bring the insights that a machine could never have. Remember that when you're using an AI tool, there's a machine learning model under the hood. It was trained on data, it found patterns, and it's applying those patterns to your situation. That's all it's doing. Which means it's incredibly powerful when used for the right problems and unreliable when pushed outside what it was trained for. Understanding that distinction is what separates people who use AI well from people who either overtrust it or dismiss it entirely. The sweet spot, in between, is where you can find massive success. Okay, so after all that AI news, what can you use that will actually help your firm? Well, as the #1 accounting practice management software, Financial Sense supports accounting and bookkeeping firms with an all-in-one platform that provides the automation, security, and client communication that you need for everyday work. And one feature that firms have been going crazy for lately is Financial Sense month-end close. Are you tired of how the end of every month brings stress, chaos, and a lot of difficult communication with clients while you hunt down transactions, documents, and details? That's where Financial Sense comes in. With our accounting month-end close software, your team can flag errors faster, ask clients questions once, and push corrections directly into QuickBooks Online. Now you can review, fix, and finalize your client books in one clean, modern month-end review hub built for accounting firms. That and so many more features are why more than 10,000 accountants, bookkeepers, CPAs, and more love Financial Sense. Find out for yourself by scanning the QR code or clicking the link below, and I'll see you on the next episode of AI Accounting.